Okay, so we're finally to the cash budget. If we're looking back in time in our financial statements, we'd use a cash flow statement. It's a summary of what happened during the year. Looking forward, we use something called the cash budget. It used to be actually way back in the early days that we'd call the cash budget a cash flow statement, but things got all mixed up about 20 years ago and they settled on that. So now we're going to call it the cash budget, and looking forward, we're going to work quite a bit with that. Okay, so our cash budget has a big advantage in that it gives us balance of our cash at the end of each month. Okay, instead of just waiting till the end of the year to see what our balance of cash might be, we get a monthly balance, which is really, really helpful. Same idea, we use it to avoid cash problems, set goals, plan purchases, and this is a little more detail and actually time them. And the cash budget, of course, helps us generate pro forma income and balance statements. So, if we start with our sales and revenue, now I've only given us 6 months here because just for demonstration purposes. If we think our monthly sales in January or January to June are going to look like this 10, 20, 30, 40, 40, 40, that's where we start. Okay, we've taken our annual sales and broke them down into monthly sort of events. Now, to illustrate how cash flow works, we're going to assume that everything we sell in this particular instance is on credit, and that we have a 45-day collection period. Recall we talked about collection period at the beginning of week 8 slides. So 45 days collection period. So remember, we do the work in January, we invoice at the end of January. We're not going to see the money till March. That's what we're talking about. Now, Excel-wise and table-wise, we fill in the next row, and that just reflects what I said in the last slide. Credit sales, matching our monthly sales, so everything's on credit. That's 100% on credit. Okay. As a result, our cash in, if we go to the next line, is out by 2 months. Okay, so we invoice the end of January. We don't get any of our sales money in January. And likewise, we don't get any of our sales money in February. We finally get January's money in March, and we finally get February's money in April. So we're offset by a couple of months here. All the way down to June, where we get $40. Yes, we had $40 in monthly sales in June, but actually what we collect, the money we get in our pocket, is our customers paying for the April sales. Okay, so we're offset by 2 months. Now, on the flip side of that, of course, is our payables, and we need to get things in the door so we can sell them, make them, do whatever. Broken our purchases up just like on this slide, January to June, and our monthly purchases are 10, 15, 20, 20, 20, 20. Okay, so we're buying for next month. Okay, I'm buying in January for next month. Okay, so we buy them. I'm going to stick with January for a minute. We buy January. We buy $10 worth of goodies to sell them in February. If I went all the way back to the sales slide, you would see that I'm going to sell something in February, hopefully. So I'm not going to pay for it. I'm going to be a good customer. I'm not going to stretch it out for 45 days. I'm going to actually pay my bills next month when I get the invoice. So they send me a bill at the end of January. I'm going to pay it in February. I'm not going to wait till March. And so that's what this looks like. Total cash out. Now, again, we assume kind of erroneously that we're starting at the beginning. Everything starts in January and that we haven't really done anything. So, again, just trying to simplify the cash flow for the first 6 months. Because really in January we'll be paying for things in December. But let's just assume we're going to start this way. Okay, so in February I pay my January bills, which means cash out of $10. Okay. Okay, so we're making all our purchases the month before, and then we pay it in 30 days. Got a bit of a quick idea check here. I'm buying things in January to sell in February. I'm paying $10 for it, and in February I'm going to sell it for $20. So what's my margin? My gross margin? Well, my gross margin would be 50%. Okay. When we write the check in February, we count it as gone, even though they might not cash the check for a few days. In terms of cash flow, that money's claimed. Okay, so we've written the check, so mentally we have to pull it out of that account, say it's gone. And we do this with our budget and say the money's gone, physically gone. Otherwise, we have this human tendency to spend it twice, okay? So in terms of Elvis money, the money has left the building, just like Elvis. So that's what we do conceptually, even though it might still be in our bank account. In terms of accounting, we say it's gone. Now, for a bigger picture, we're going to put the receivables and payables together. Okay, now here's what they look like. So the top part is the sales. The gray part is the purchases. So we've got a lot going on here, but really, if we separate them out again, it's not that difficult. Okay, so our monthly credit sales, if I go, let's have a look at May. Monthly credit sales are 40. My collections are 30, so I'm actually collecting March's money, so my cash in is 30. Okay, next line down, first gray line, again in May, my monthly purchases are 20. Okay, monthly purchases are 20. I'm paying off 20, so I'm paying off April's money. April's purchases, but in May I'm also buying enough to sell in June. Okay, so my total cash out, again in the month of May, is 20, and the difference is 10. I actually get a net of 10. So my cash in is 30, my cash out is 10. Next month in June, things will look a little better because my net cash in is 20. But wait a minute, let's go all the way back to February. Okay, in February, even though I sold $20 worth, I didn't get any cash in. But I paid for January's, which means I had a net cash out of $10. So minus 10 in total went out the door. 0 cash in, 10 cash out means I had cash flow in that month of negative 10. March gets a little better. Okay, I'm finally getting my money in from January, so that looks good. However, I went down and paid for February's purchases. Okay, paid for February's purchases, but I didn't get any money in for March sales. So I've got a net cash out of $5. This is the biggest problem we see in small business. We say, okay, well, we're going to have cash out here in this month and this month and this month, but there's one thing that this slide is not showing, and I'll move into that in the next slide. And that's the total amount of cumulative money in or out. So each month we've got our net in and out, but that doesn't really show the whole picture. So let's move on to the next slide group.